Hi class, this is Mr. Tan, and today we are focusing on hospitality and finance, Unit 2, and we're on question 5.2. And 5.2 is looking at or asking you to produce a marginal costing statement, marginal income statement, as opposed to an absorption statement. And if we remember, an income statement includes your sales minus your cost of goods, gives you your gross profit, minus your administration charges, gives you your net profit. So the question really is, what is marginal costing? So Mary, what is marginal costing for anyone?
Well, marginal costing is when a fixed production overhead not allocated to product.
Yes, fixed allocated production is not allocated to product. What else?
And when it traces only variable costs to
Yes.
products, while fixed costs and production are considered periodic only.
Yes.
Expenses.
Yes, so the traces only variable costs to the product, whereas fixed costs of production are only considered periodic expenses. And what else?
And it includes direct materials and
Includes direct materials, direct labour, and variable costs.
overhead.
But why is this important? Why is it important? Anyone? So you've got the individual variable costs. Why is it important? It's important because if you can work out your variable costs and you can itemize each variable cost that make up the cost of goods sold, and when you take away the cost of goods sold from the sales, then you get your gross profit. Then if you divide your gross profit by sales times 100, gives you your gross profit percentage margin. So if you can itemize the variable costs in your gross profit, then you can work out if you can buy them cheaper, if you can cut that out, or if you can decrease the cost of a specific item to reduce your overall cost of the goods sold. And if you can reduce your overall cost of the goods sold, then you're increasing your overall gross profit, and therefore, when you work at your gross profit percentage margin, you're increasing your gross profit percentage margin in comparison to industry standards. So that's the reason why it's so important. Okay? It allows you to get more control of the individual items and to see what you can do to make more profit eventually for the company. Okay, so in the item, in the table that we had, what did we work out? If we look at the table again, so what would be the sales in this table then? What's the total sales using this example that we've got? How many tickets are sold?
150,000.
But how many tickets are sold?
5,000.
5,000. How much is the selling price per ticket?
30.
So 30 times what?
5,000.
Gives you how much?
150,000.
Good. So the total sales are £150,000. Now we need to work out the variable costs in the cost of goods sold. So what are the variable costs in this table, please? Tell me the three items that are variable costs.
Cost of wages.
Cost of wages to make the ticket.
Cost of printing tickets.
Cost of printing the ticket.
Cost of popcorn.
Cost of popcorn. How much is the cost for wages to make the ticket? £10. Times how many tickets?
5,000.
Gives you how much?
50,000.
£50,000. So you've got to take that away from your sales. So the cost of the printing the ticket is how much? £1 times 5,000 gives you 5,000. Take that away. And what else? The last one, £2 per popcorn. £2 times gives you.
10,000.
Total cost of the goods sold is how much? What is the total cost of the goods sold?
150,000.
Total cost of the goods.
80,
Total cost of goods.
85,000.
So 50,000 for the wages, 10,000 for the popcorn, 5,000, so 65,000. 65,000 for the total cost. So this total is 65,000, yes? Okay, 65,000 minus what? Your sales minus your sales gives you how much?
150,000.
No. 150,000 is how much?
That's just sales.
It's your sales. Minus your what?
Cost.
Cost of goods sold gives you how much?
85,000.
Gives you 85,000.
Which is your gross profit.
Which is your gross profit, bingo. And so here, in the example, you worked out the variable cost associated to make that ticket. Yeah? But you could, if total it all up, but then it wouldn't give you the breakdown. But you need the breakdown. Okay? And then we take away our administration charges. What are our administration charges, please, using the example?
Admin charges.
What are which? On the table, which are which?
35,000.
So rent for the use of the hall, thank you, Mary, 35,000. What else?
Electricity bill,
Elec-
6,000.
Electricity bill, 6,000, good.
Telephone,
And telephone bill charge, how much?
2,000.
2,000. So here, you take away your administration charge for your rent per annum, your telephone charge, and your electricity bill. Take that away from your gross profit, gives you how much for your net profit?
42,000.
42,000. Okay, so that's your net profit. How do we work out net profit percentage margin, just out of interest?
Net profit divided by sales.
Yes.
Times 100.
Good. Net profit divided by sales times 100 gives you your net profit percentage margin. Good. You need to see this picture in your mind to actually get this, so then you can apply it. It's actually very, very good if you're actually doing your own income statement for your own business or working for your hotel, whatever. So then you can look at the individual costs to see how you can improve the efficiency of your overall profit. You improve the efficiency, you may be paid more. Maybe. Okay, so obviously you need to work out the answer. So you work out the answer, and I want you to explain what marginal costing is and how it applies, okay? Yes?
Yes.
Okay. Any other questions? Thank you. Mr. Tapp.